Last week was a very bullish week in terms of the, if you look at the candlestick, it was a hammer. We made a low just around 4,100 on Monday. Gold was down like $400, and then it rallied all week, and it closed, I think, around 4,500, just below 46. Not sure exactly where, and that means that the market rejected that sell-off. The question now is, well, the question at the end of last week was whether we're going to continue rising this week, and it's proven that we have now the last few days. But I don't think it's a dead cat bounce, but I think we need to, of course, make new all-time highs eventually, and then we'll be able to call this what we've had since the end of February, a correction. And I think it was a correction. And looking at the high from on the Monday after the war started, it was around 5,400. And I take that one because the previous one around 5,600, there was a slight correction there, and then it came back up. So from the high there after the war started, it was about 24.7%, which historically is normal. We had a 25% correction in 2006, and a 34% correction in 2008. But we hear, of course, in the mainstream media, they like to say, oh, this is the biggest correction in gold since 1983.
Yeah.
But that's
in absolute terms.
Nominal terms. But in percentage terms, I think this correction was probably a good thing.
This engineered market volatility is designed to distract the public from a terrifying mathematical reality. The entire global economy is currently running on a completely unbacked, debt-based fiat currency system, and that massive financial experiment is finally reaching its mathematically guaranteed breaking point.
Because since 2004 to 2024, when you started going really motoring in gold, the corrections have been pretty shallow, like 8 to 11%. So yeah, that's all I think. It is a correction, and I think, Paul, going forward, we're going to see even bigger corrections because gold is going to go up even more, or the fiat currencies are going to sink even more. In 2015, that I needed to let the world know that what we're experiencing now, I think, would be coming. And what are we experiencing? Well, I think we're near the end of this experiment, which is really an aberration, a reserve currency, a world well, it's a non-system, but a world system based on debt that you can never pay back. That's mathematically, that's bound to fail. We've seen that there's a lot of insider trading. We can't deny that now, especially from the United States. That who knows, people on the inside have known all along that this war was going to start. So they started buying last December in January. Right. And then they drove gold up to 5,600. And it's the old adage, you buy the rumor, you sell the fact. And you sell the fact just because you've made the money. And now the war started, you just get rid of it. I'm sure the usual suspects got into because they can. When people are selling because they need liquidity, they'll hit any bid, and the bullion banks, they have easy access to the market, so they just go along for the ride to make fiat currency profits. And Turkey, I've heard that they've done it as a swap. So they'll sell it. It's sold 60 tons, but they'll buy it back in a month or 3 months, whatever, just to cover liquidity. But I also saw that Turkey sold a lot of their treasuries.
Yeah, more than they sold gold, right?
Yeah. And that treasury, someone noted, you don't really need to sell it because you can just use it as collateral for a loan. But so they just got rid of it. And so there's, and technically as well, like yeah, some things get a bit frothy, and gold and silver can get frothy, and also fiat currency, they can accelerate massively lower, which is the opposite of gold and silver going up, and then there's just a correction. I think someone's published a chart of the Reichsmark back in the early 20s, prior to the collapse in 23. The volatility was huge. So, and I've always told my viewers and the followers that you need to hold on to the bull, for dear life, because that's why it's called the bull market, because very few people go along for the whole ride because they get scared off, thrown off the bull. And I think this was an incident where that happened, and I've gotten immune, even though it's not nice to see. It feels a little bit. You always, things are never for certain in life, so you always question things. But I've been through it. I went through the '08 correction.
The entire purpose of a violent correction is to inflict maximum psychological pain, specifically designed to terrify weak hands into surrendering their physical wealth back to the banking establishment.
And went through from the correction that we had from 2011 to 2015. That was like a pretty bad bear market, and it's you just gotta try to buy it when it feels really bad. And I did actually buy some last Monday. I don't always catch the right time, but I thought to myself, $400 in one day down is a bit too much. So I bought a little bit, some sovereigns, and that's turned out okay.
And if I look at some of the recent reports from bullion banks, like investment banks like Goldman and Wells Fargo, they also confirm the bull market remains intact. And with I think most of these banks have higher price targets than we currently see. Also interesting to notice that I talked to a big pension fund manager this week in Holland. He runs he's strategically responsible for 200 billion plus of Dutch pension funds, and he's now advising all of his clients to own 5 to 10% in gold and commodities. It's a bit like Morgan Stanley last year advised their customers. So it seems like we're still very far away from all of that money flowing into precious metals.
Yeah, and I don't follow the mainstream too much, even though I see clips of stories on X, and I do subscribe to the FT and Bloomberg. But like yesterday, all the talk was the recovery in the stock market, that the war is going to end, and interest rates are going to be cut, and everything is going to be fine. But no talk about the fact that gold, silver, the miners, and the Bloomberg Commodity Index are up quite comfortably for the first quarter. All I saw about gold and silver was that they had the worst month in ages, but they didn't say, well, they're still up year to date, while the stock market is down year to date. So there's very little awareness, I think, of gold, commodities, and miners in the mainstream investment world. I guess your Dutch pension fund guy, he's probably an exception. But as we move along through time, I think that's going to change massively. People are going to realize that the gains that they're making maybe in the general stock market are kind of diluted by currency debasement. And if they really want to protect their purchasing power, they'll have to have gold and silver. Fund managers, as long as they're doing what other fund managers are doing, they feel comfortable. Even if they lose, let's say 10%, and everyone else, all the other ones lose 12%, they say, "Oh, I outperformed,"
Yeah.
So yeah, I can see that happening. If maybe Morgan Stanley has gotten the ball rolling, and I still don't see any other big investment bank in the US or in Europe changing their 60-40 allocation. But maybe after the first quarter this year, which ended yesterday, maybe people are going to start saying, oh, maybe we do need some gold and silver and commodities.
Could you perhaps summarize what's going on in the private credit market, and do we need to worry about that? Is it going to trigger perhaps a new, greater financial crisis?
Well, I think it's just one of the things that could trigger another big financial crisis. We've got loads of other stuff like Iran, but the private credit, I'm not a specialist, but I've been looking at it for the last few years. Is like private equity, private credit, and basically after the '08 crisis, the regulators said to the banks, you can't lend to these kinds of borrowers anymore. So private credit it was the consequence of those rules, and it's not regulated at all. It's very opaque. You can't trade those private credit instruments in an exchange. And the only way you find out how much something is worth is if you can sell it. And we're seeing now that a lot of these investment vehicles are being frozen. People trying to liquidate them, and they can't, even though it was in the small print, right? So, yeah, it's very, and we don't know if they've, investors, Wall Street hedge funds have also written derivatives on them. That could make it even worse. So, yeah, it definitely has a chance of triggering bigger crisis. And but I think the central banks will be ready to provide the liquidity.
But what would you think if you're like, I'm 45? If you're my age or a bit older or a bit younger, what would be like a decent percentage of gold to have in your portfolio, given everything that's going on right now?
More than 50%.
More than 50, okay.
Yeah, gold and silver, yeah. Diversification sounds right, but I think it was Stanley Druckenmiller who said, I don't diversify. I just go for what I think is going to do really well and then go all in. But I think it's more important not to live within your means and have positive cash flow, i.e. savings coming in every month. And don't borrow to buy gold and silver. That's what I would say. And I guess always have a little bit of fiat cash on hand, I guess, so you don't have to sell your gold and silver if you have an emergency. That's what I would do. But at your age, 45, I think, I would have more than 50% in gold. And of course, that's not counting, let's say, if you own your own house, for example. I'm not counting that. I'm just counting like investable or liquid assets.